It's 2022. What is going to happen with the tax code? Well, I'm sure you want to know, and by the end of this video, you're going to gain clarity about your personal tax plan, your personal retirement plan, and you're going to have action items to secure your retirement.
To learn more about securing your retirement and all the different elements you need to know, subscribe to our channel and hit the bell to be notified when we post a video every Monday. We have helped hundreds of our clients gain clarity and get on the path to a comfortable and happy retirement. Now it's your turn. Let's dive in.
Welcome, everyone, to our podcast. Today is the version that we usually reference as Retirement in Action. We have a couple different formats that we try to cover. One of those is an interview. The other is what we call Retirement in Action. And that's where Merce and I take this opportunity to hit a topic that we're getting questions about, or that we've dealt with within the last little bit within our practice. And hopefully by the fact that somebody else asked the question, we always say that probably you have those questions as well. And today we are going to talk about a topic that everybody wants to talk about when it comes to their planning and their concerns, and that is the tax code. And we're really calling this particular episode the 2022 Tax Guide. Now, there have been adjustments, none of which are major from 21 to 22, but we wanted to take you through those numbers and kind of give you some things to think about when it comes to different aspects. So today we're going to talk a little bit about, I'm kind of give you an outline here. We're going to talk about our ordinary tax, income tax limits, federal. We're talking all federal, the amounts, limits, things like that we can put into our 401k, our traditional IRA, a Roth IRA. And then also we'll talk just a little bit about dividends. A really big one is Social Security tax, or taxes on Social Security, at what those points are. We're going to hit a little bit on Medicare Part B premiums as to how those are affected based on the different parts of the tax code. And then we'll talk about a couple other little things as well. But we hope this will at least give you a nice overview of the tax code, tax situation for 2022. I will tell you that we're going to go through a lot of numbers. We're going to go through a lot of different scenarios. If you're listening to this, you're driving, you're walking, do not sweat it. We have a blog written on this very topic. It's right on the website. All these numbers, all these details are going to be right there for you. And we're glad to be able to provide this for you. So I say we jump right in, Merce, and if you kind of want to give us your observations around the ordinary income tax, any things you see there, and then we'll just kind of have a nice conversation on this.
Yeah, sure. So the ordinary income tax, that's the tax that you pay based off of what your income is for the year. And for the most part here, not really seeing any changes to, say, the tax percentage level. So basically what we have is you've got a couple of different, we put them in the phrase of brackets, tax brackets. Hey, what tax bracket are you in, or what are you filing in, or what did you end up paying from a tax percentage? And so your income, however much money you make through the year, whether it's W-2 or 1099, that all adds up and then lands you into a tax bracket. And those brackets are unchanged. So the brackets are 10%, 12%, 22%, 24, 32, 35, all the way up to 37%. Now, how you land into one of those or a multiple of those depends on what your earnings are for the year. And so we're not going to go through all of the details, but what I want to do is just to give you a little bit of an idea as to what the numbers are. And then also there have been some changes as to the range that qualifies you into a certain bracket versus another. And so let's just start at the beginning. So if you have earnings or income of $20,550 or below, then you are in the 10% tax bracket. The next level is basically from that 20,550 all the way up to 83,550. Now you are in the 12% bracket. And then it goes to, you're making 178,000, you're now in the 22% bracket. And it keeps going up. So the more income you make, the more you're going to pay in taxes. And it's on this stepping type of rate. So Radon, I'm going to ask you a question here in a second, because sometimes a confusion happens that says, well, if I made, according to the table, if I made $400,000 $40,000 this year, that's going to put me into the 35% tax bracket. And sometimes there's a confusion as to, is every single one of those dollars taxed at that 35%? And that's something that I would like to go over very briefly. But before I do that, just to give you an idea as what the changes are. For example, if you were in the 22% tax bracket for 2021, you had income of up to $172,750 for the year. That puts you into the 22% tax bracket. The only change for all of the brackets has been a few $1,000s. So now you can actually make up to $178,150 and still be in that 22% tax bracket. So last year it was $172,750. Now the threshold has gone up by about $6,000, a little bit less than that, to $178,150 to keep you into the 22% tax bracket. So all of the brackets have extended a tiny bit, a few $1,000s. So that's really the only change when it comes to ordinary income tax levels. So back to my question, Radon, can you give us a high level as to how our tax system works when it comes to income taxes?
Yeah, so our tax system is what is called a tiered tax system. Now, we're going to work off of what the tax code, or what we would have on our tax return, which is what's called an adjusted gross income. An adjusted gross income is after you're able to take either a standard deduction or other deductions, whatever those might be. And then that's kind of how we start to break down what our income tax is. So let's assume that we're now talking about what's called our adjusted gross income. We've taken our standard deduction and we start there. So whatever that is, from zero, after that number, from zero to $20,550, on that section of money, I owe 10%. So I'm going to go back to actually your scenario, Merce, and let's say that somebody owes, or somebody has an adjusted gross income of $440,000. Now I'm going to walk through a bunch of numbers. Don't worry. Remember, I told you we're going to have this all on our blog, so don't think about having to write all this down. But the way it works is from zero to $20,550, on that section of money, the first $20,550, I only pay 10% tax on that segment of dollars. Then everything above $20,550 all the way to $83,550, on that section of money, I owe 12%. Now, from $83,550 to $178,150, I owe 22%. From $178,000 to $340,000, I owe 24%. And then from $340,000 to $430,000, I owe 32%. And then on that last $9,000, so from $131,900. So Merce said, I made it to the 35% tax bracket. I made $440,000. I only owe 35% on the last $9,000. The rest of it was at 32, 24, 22, 12, and 10. So if I want to know what my average tax bracket is, what I would do is do all that math, come up with what tax I'm going to owe, and then divide it by the whole number. And that would be my effective, if you've already heard that term before, my effective tax rate, meaning I've paid it at different tiers throughout the whole process. So that is going to lead us now to a different conversation. I hope you understand now, tiered tax system. And I want to now bring up a topic when it comes to income tax that comes to this idea that we get sometimes around a Roth conversion. A Roth conversion fits really nice when you understand this tiered system. When you get it, you go, aha, I understand now how I would pay a certain tax rate on a piece of money. So I'm going to go back to this scenario of, let's pretend that your income is right now at, say, $85,000. Your adjusted gross income is at $85,000, and you say, I want to convert as much as I can and stay in my current tax bracket. So if you're at $85,000, married, filing jointly, all these numbers I just went through are married, filing jointly. The single tax code is the same tiering, but the dollars I can make as a single person is not as much as I can earn if I'm filing married. Okay. All right. So I make $85,000, and you say, how much can I convert and still stay in the 22% tax bracket? Well, I can convert everything from 185,000 all the way to 178,000. And all of that conversion is going to be at a 22% tax bracket. If I convert anything above that 178, it's going to only on the part that I go above that. So if I go above that by 10,000, that extra 10,000 is going to be converted at 24%. So a lot of people say, I want to make sure I don't go above the bracket that I'm in. What's my range within that bracket? Now, I will say this real quick. If you're listening to this and you're thinking, oh my goodness, this is really overwhelming and I'm trying to figure it out and I want to see how this works, we do have a software program that can actually do all this math for you so you can kind of see what it looks like. And we're glad to be able to help you with that if you'd like. And if you go to the website, we've talked about this before, you can click on the button at the top right-hand corner and just be able to schedule a 15-minute phone conversation with Merce and I, and we'll be able to walk you through if that makes sense or not. Anything else on this, Merce, that maybe on that topic or anything else around the ordinary income tax?
Just one thing that I think is worth noting, and especially if you're trying to do some longer term planning over the next few years, like Roth conversions, a tax cut was put into effect a few years ago called the Tax Cut and Jobs Act, and that is set to expire in 2026. So what that means ultimately is that if nothing changes in legislation right now, tax rates, the marginal tax rates that we just discussed, some of them are going to be going up. Not crazy, but they are going to be going up. So to give you an example, if you're in the 12% bracket in 2026, that 12 is going to go to 15. The 22 is going to go to 25%. The 24 is going to go to 28. So those three sections of the marginal tax brackets, those are going up in 2026 due to an act that was put into place years ago expiring. So something to think about as you are doing some planning, some strategy. Tax rates are going up a little bit here in the near future. But that's really all I've got for ordinary income tax. I think it is important to always revisit every single year when we're talking about thresholds and limitations as far as what we can put into plans, what type of plans that we have. Those numbers are supposed to be moving around with inflation. So almost every year we do get an increase into what we can utilize from a tax perspective. So the standard deduction has gone up a small amount, but it has gone up. If you are single, the standard deduction last year in 2021 was $12,550. In 2022, this year, it's $12,950. Married filing jointly went from $25,100 to $25,900. So a little increase there.
Before you go on that, Merce, before you go any more on that, and we need to really clarify here, we're just basically reading numbers to you and maybe trying to give you some understanding. We are not CPAs, but could you just briefly, I think you went into that, and just to kind of say, what is a standard deduction? Like how would that work as far as a person thinking about their income?
Yeah, I mean, so essentially the standard deduction, and these changes happened a few years ago to where they really increased the standard deduction. And so it's basically, it comes right off of your income. Everyone gets the standard deduction. The amount that you get depends on whether you're single or you're married filing jointly. And it comes right off. So let's say you make 50,000 and you are single and your income is 50,000 for the year. Well, effectively after the standard deduction, you take 12,550 off. So you're right at that 37,000 income amount. So you automatically get a chunk of your income taken away as for what they call the standard deduction. And then things get added to that. But the other way that someone may file is not doing the standard deduction, but they're doing itemized, what's the word here, Raiden? Itemized.
It's itemized deductions.
Itemized deductions. And so a lot of people have realized that because the standard deduction got so strong over the past few years, that it's really difficult to itemize your deductions anymore. But that's a whole different conversation. And again, we are not CPAs. We're just giving you some information here. Another change that has happened, and I kind of noticed it not too long ago, which is the 401k, 403b, 457 plans, all those retirement plans that you get to contribute to throughout the years. That number has gone up a little bit. So if you do salary deferral, so you're out of your paycheck, every single pay period, some money goes into one of these retirement buckets. The maximum has gone up from 19,500 to 20,500. So $1,000 extra per year that you can put into that. And then on top of that, if you're over age 50, you can do what's called a catch-up contribution. This number has not changed, but it's still there. So if you're over 50, you can do salary deferrals this year of $20,500. And then also you get to take advantage of the catch-up, which is $6,500 a year. So if you are if you're have the mindset to maximize your 401k or your 403b contributions, you can really put in from your salary $27,000 this year. So that's a nice number that has gone up a little bit. If you're self-employed and you utilize what is called a SEP plan, stands for self-employed pension plan, kind of works like a 401k, kind of like an IRA, has a little bit of a hybrid, has some different funding rules, but the maximum that you can put into that has gone up to $61,000 this year from $58,000 last year. So that's a nice increase as well. What else is on here? If you have an FSA or an HSA, those numbers have gone up a little bit. HSA is a health savings account that you can contribute to if you have a qualifying medical plan. FSA is usually with an employer. Some of those contribution limits have gone up as well. Anything you think I'm missing here, Raiden?
No, I think you covered all those really well as far as all those different numbers. So I think it's pretty good for us to move on here briefly, and we'll talk a little bit about capital gains. Now, capital gains are if you have a stock, for example, that you have a gain on, or anything that's long capital gains, a property, but let's just talk about stock. And I have a capital gain on it. If I sell that stock prior to a year, then it's called short-term capital gains. What that means is you just count it as income. It goes back up in that column that Merce and I were talking about as ordinary income. So all those brackets apply. If, though, I hold a stock for longer than 365 days, meaning longer than a year, and I sell it, any gain that I've got on there is a long-term capital gain. So just so you understand that, again, this is a little bit of a tiered system as well, just not quite as much as the tiers that we have on the ordinary income. Basically, in 2022, I can make up to $83,000 of long-term capital gain if that's what I'm considering, and I can qualify for a 0% tax on that when I look at that. Now, there is some calculations to go in here, and so I'm giving you, again, some rough numbers, and remember, we're going to refer you back to the CPA all the time on this. But then I can go up all the way to $517,000, and I only pay 15%. So you'll notice that that's a lot less than the ordinary income tax. And so that's extremely important. That's why it's advantageous if we have a plan where we want to hold long-term capital gains. Now, if I do more than $500,000 in long-term capital gain, or more than $517,000, I'm going to pay 20% on that. Again, this may or may not apply in your case because it does not apply at all to IRAs, Roth IRAs, 401ks, 403bs, 457s, all of those. When I pull the money out is when I'm going to pay tax on it. This is talking about a stock that's not in that kind of an account that you pay long-term and short-term. This long-term, short-term thing does not apply at all in the ordinary income tax. Okay. All right, Merce, can you just help us with a nice little overview here on the Social Security section? I think a lot of people wonder, how is it that Social Security gets taxed, and what's the math on that as to at what point do I start to get taxed? So if you can just run through those numbers with us briefly.
Yeah. And we have this conversation all the time that a lot of people are surprised Social Security is taxed at all when it's something that you've been paying into for quite some time, and you receive it at a qualifying age of 62 or above. But yeah, it is taxable. And really there's two thresholds that you need to know. And by the way, there are no changes here from 2021 to 2022. So it's exactly the same as last year. But if you are say you're married filing jointly, you're collecting Social Security, and your income is anywhere from $32,000 to $44,000 a year, then up to 50% of your Social Security income will be taxable. So if you get $2,000 a month from Social Security, up to $1,000 of that is going to be considered as taxable income. Now, in the scenario where you make a good income in retirement, well, then that number is going to go up as far as the percentage as to how much is taxable. So if you make more, again, married filing jointly, more than $44,000 of annual income, then the number goes from 50% to up to 85% of your Social Security is now taxable. And the numbers are a little bit different if you're filing single, but the idea here is that Social Security can be taxable. For a lot of people, it is taxable. It's just as to what degree of income you have as to how much of your Social Security will be taxable.
All right, real quick, I want us to go through these next couple topics. I know that we try to keep these retirement and actions at around that 30-minute or less mark. So we know we're going through a lot, and we hope that you're hanging in there with us. I do want to talk a little bit about the Medicare Part B premium. And the reason why I want to mention this is I think if as a percentage, this is quite a jump this year. In 2021, for example, if a person made anywhere from 0 to 176,000, the premium on their Medicare Part B was $148.50. That is this year in 2022 going to jump from $148.50 to $170.10. Now, and that's monthly, by the way, a monthly premium. So that's taking it up, a little bit as a percentage. I mean, again, the difference between 148.50 and 170.10 is probably not going to make a difference in most people and saying whether or not they get to go on vacation. But the reality is that's percentage wise, that's quite the jump. Now, if I make over 182,000 up to 222, these go up. And I'm not going to read through all those, but it's tiered very much like everything else. The higher the income, the higher the premium. So just keep that in mind as you're thinking about that. But I didn't want to say a lot on that. I just want you to know that there are premium increases coming in 2022 on your Medicare Part B. So think about that. It might be something that you need to adjust in your income plan. It's not like, again, earth shattering, but it is an increase. Merce, can you talk a little bit about this? This comes up a lot. If I'm taking Social Security under what's called full retirement age, how much money can I make and it not be penalized?
Yeah. So you can take Social Security as early as age 62, but what you have to remember is that if you're taking it before full retirement age, which for a lot of us is 66 nth months or age 67, if you're taking it before full retirement age, then you could be subject to reduced benefits if you're making, say, too much money while working or some other type of income scenario. And you don't have to make a lot before your Social Security could be reduced. And so let's say you file at 62, but you're also making $25,000, $30,000 a year through a part-time job. Your Social Security could be impacted. And the number here for 2022, if you make more than $19,560 in income outside of your Social Security, then that Social Security is going to be subject to a penalty or a reduced benefit. So something to consider. A lot of times we like to think about retiring early at 62, drawing that Social Security, but also have some other side gig or something like that eventually or possibly generates too much income and we get penalized for it. So just keep that in mind, that there are limitations as to how much income you can make if you take Social Security early.
All right, our final topic to close us out today is on the Roth IRA. The Roth IRA, you can contribute up to $6,000 a year. Under 50 and above can do another 1,000, so 7,000 into the Roth, as long as you had that much earned income. So if you only made $1,000, you can only contribute $1,000. But if you earned $6,000, you can contribute $6,000. If you earn 10, you can contribute 7 if you're over 50, 6 if you're under 50. Now, there is a little little thing to consider on that, and that is how much income can I make. So the phase out begins in 2022 for a person married filing jointly at 198. So ultimately, you're going to start to get phased out of how much you can contribute once you're married filing jointly is above 198, 125, 125,000 for a single. And then you're completely phased out, married filing jointly at 208,000 and on a single at 140. So if you're a good income earner, the Roth may not be a consideration, but I will tell you that if you can contribute to the Roth, it is something to consider. We find it to be very, very beneficial. And when you run the numbers out, we have some clients right now that have very sizable Roth IRAs. And I will tell you that it's a super exciting thing to know that this money is growing tax-free and you can get it out tax-free. And so it's a huge, huge advantage. But anything else at all, Merce, on this that we might have missed or skipped over before we conclude?
No, I mean, this has been good. I know that we threw a lot of numbers at you, like Braden said. There will be a blog published that has all these numbers in it. And it's good stuff to know, especially as we sit here in January at the beginning of the year and you're making some financial goals, some things that you want to tweak with your plans, your savings and everything like that. It's good to know what you can do and what the impact is going to be. So that's the whole purpose of this episode.
All right, everyone. Thank you so much for listening to us. We are so excited to be able to share this with you. It's something that Merce and I look forward to every single week. We hope you have a great week. We'll talk to you next Monday. We hope this video has given you some confidence and clarity as you plan for a worry-free life in retirement. But what else do you need? We have created a complimentary video course called 3 Keys to Secure Your Retirement. This video walks you through step by step what you need to do to get ready for retirement. You can also check out our podcast called Secure Your Retirement. You can subscribe below.
For more retirement tips, watch this video. Create your retirement income plan. Also, click here to subscribe to our podcast, Secure Your Retirement. If you like this video, hit the like button and be sure to subscribe and share it with your friends.